All right, so you were on a winning streak. It was no possibility that you could lose a trade. So you put on more and more risk, and then everything went against you and you blew your account. Now what? Hi guys, welcome back to my channel. If you guys are new here, my name is Mel, and today we're going to be talking about one of the most important parts of trading, at least in my opinion, and that is risk management or proper risk management. Proper risk management can take you from an okay trader to a great trader, because let's keep it real, trading is about probabilities, and sometimes you're just going to lose, and it is what it is. But with the right risk management on your side, you can still be profitable, and I'm going to show you how. So let's define risk management, and it's nothing complicated. It's very simple, actually. It's just what it is. It's the amount of money that you're willing to risk on any given trade. And a lot of professional traders would say only risk 1% of your total account on any trade. So for example, if you have a $10,000 account, this means that your risk on this particular trade would only be $100. So this means that you would have to lose 100 trades to completely blow your account, right? And if you're losing 100 trades, maybe we need to reevaluate, our plan, our trading strategy. Maybe we need to tweak some things, right? So Paul Tudor Jones himself, and if you don't know who Paul Tudor Jones is, this is Paul Tudor Jones. But Paul Tudor Jones, he's one of my favorite traders, day traders. He's one of the most successful day traders. And he even said that he goes into every trade with the idea that he's going to lose. And then he also looks for reasons that he is wrong versus reasons that he is right, like most traders tend to do. And that's called confirmation bias. So even Paul Tudor Jones says it, and he was super successful at day trading, which he mainly traded futures. You can literally be right 50% of the time, or even less. You could be right 40% of the time and still have a winning strategy if you use proper risk management. And I'm going to show you how. All right, so going back to this 1% rule. So for me, I do use the 1% rule, and then I also use a reward to risk of 3 to 1, at least, at minimum. If I can get more than that, perfect, but if not, 3 to 1 is usually my minimum. So by 3 to 1 reward to risk, this basically says that if I am going to risk $100, I need to be at the very least, making $300, right? So you need to define your risk first. That's first of all. Anytime I'm about to place a trade in the morning, I always either chart the day before the market opens, or I am getting up early and I'm going to chart right before the market opens. But I am going to decide way ahead of time how much I am risking, right? So let's take a pool of 10 trades with a 3 to 1 risk to reward. And my risk in this situation is $100, right? So if I am 50%, if I have a 50% win rate, 50% loss rate. So if I lose 5 or 50% of the trades, if I am risking $100, this is going to equal up to $500 loss, right? But if I win 50% of the trades and I'm at a 3 to 1 reward to risk, 300 times 5 is 1,500, correct? So 1,500, which is my reward, minus my loss, which was $500, is equal to $1,000. So you see how I could literally not win all the time and I could still be profitable. Because the thing about trading is you could see a level, you could think that, oh, this is gonna definitely work for me, but like Paul Tudor Jones said, what if it doesn't? What moves the markets are, news, things may come out. People move the markets essentially. So people, we already know feelings are very fickle. So never put too much faith into one stock or one position, because what if it goes against you? Then you got to think about, what if I want to put on that much risk? I could have been up, right? So never put on more risk that you're not okay. If you're not okay with losing it, don't even attempt it. All right, so now I am gonna pull up Shopify's chart on TradingView, and I'm gonna do an example of how I go about calculating my risk and deciding how many shares to buy. So I have Shop pulled up. As you can see here, I've already got it charted, and I'm currently in this trade. I'm swinging this trade because there is a gap, and gaps sometimes take a little while to fill. But I actually got into this trade on June 24th, where I have my my mouse, and how I went about doing it was, first of all, there was a level here where the price went up and then it stopped because of the gap, and then it broke out and it was looking like it was trying to fill. Well, when it came back, the price went down here on the 18th, it stopped, and then it went out here, and then it was retested on the 24th. So I got in here, and my reward is where the drop off happens. So it may take a while. Sometimes gaps don't always fill, but I will manage my risk by moving my stop up. That's what I do. That's what it's worked for me. You know, some people don't believe in that, but I'd rather have some profit than to lose completely everything. So my reward is up here at the open of this candle on May 7th, prior to the drop off, probably due to earnings. And so the open on this was at $76.53. All right, so now you have the numbers. So we have the entry. So I entered at the price of $64.50. And then I always put my stop a little bit below where the demand is. So right here, you can see people were buying here. So I'm going to put it a little bit below where the buyers were buying, just in case, to give myself a little wiggle room if it does start to go against me. Let me take you to my board so I can do the math for you and show you how I go about calculating it. We entered at $64 and around 50 cents. So this is going to be my entry. All right. And so you remember I told you I always give myself a little wiggle room, and I'm going to place my stop around about $62.80. And I do have a method about going about where exactly I place my stop. Comment below stop if you're interested in knowing how I go about doing it. And then my take profit level was at about $76.50. Okay. All right. So these are the three numbers that we're working with. Okay. So the first thing I want to do is I want to calculate my reward. Okay. So from here, from $64.50 to $62.80, this is my risk. All right. So on the side, I'm going to do my, calculate my reward to risk first. So I'm not going to write it on my board just because my board is kind of small, but I am going to calculate it, and you can also calculate it. So what I do is I subtract my entry from my take profit. And so that's $76.50 minus $64.50, which is going to be $12.50 worth of reward. And then I'm gonna subtract my stop, where my stop is placed, from where I'm entering. So $64.50 minus $62.80, which is gonna put me at about 1.7, right? Okay, so, and that's my risk. So now you're probably trying to figure out, okay, so how many shares do I buy? So what I do is I take the amount that I'm willing to risk, which I'm going to put $200. And so just say if I had a $20,000 trading account, $200 would be the 1%, which is the 1% rule that I told you that I go by. So willing to risk $200, and I'm going to divide that by my risk. So willing to lose, I'm going to put willing to lose minus or over risk, so you'll know. And 1.7 is my risk. Okay, so now you divide that. So 200 divided by 1.7 is 117 shares. All right. Yeah, 117 shares. So you can check this math. So basically what you're doing is, oh, and then I'll skip a step. So 12.5 divided by 1.7. You want to know your reward to risk ratio as well. So 12.5 divided by 1.7, that's a 7-to-1 reward to risk. So I'm good because, you know, I told you I'm at least at a minimum of 3-to-1. Of course, 7.1 is great. All right, so back to 117 shares. So reward. So 117 multiplied by 12.5 is about $1,400. So we at $1,400 reward. And my risk in this, remember I told you we're only willing to lose $200 because that's my risk. So 1.7 times my shares of 117 is about $198. So right at $200. So if I were to take this trade, if I'm looking at it, if I'm gonna be, you know, home, I'm not gonna be at work. I may not put in a hard stop. But if you are gonna be out on the go, you don't want to pay attention, I would put in my stop in this case to be at $62.80. That way, if this trade goes completely against me, I am taking completely out at $62.80 with a loss of only $200. All right, guys, so that's really the end of the video. I just really wanted to show you how I go about using risk management and why risk management is so important. And it's one of those things that you definitely need to keep in your toolbox if you do want to be a successful trader, because I mean, once again, trading is about probabilities and sometimes you're not going to be right. That's okay. It's all about trading. I promise you, professional traders will tell you they're not 100% right, and that's fine, but you do want to make sure you have risk management in check. Okay, comment down below, let me know if you enjoyed the video, what you may want to hear from me in the future. Like, subscribe, share this video with a family member, a friend, and yeah, I'll see you guys next time.